Redemption of debentures. Redemption of debentures. Yeah. So Sam, have you got muted? Is voice is clear? Yes. Okay. Fine, ma. Okay. Fine. So now redemption of debentures, my dear friends. Redemption means, my dear friends, it is cancellation. Cancellation of debentures. Cancellation of debentures officially. So that is in your book. So at the time of issue, the net entry what you would have passed was, so bank account debit to debentures account. Bank account debit to debentures account. Got it? Now it is a reversal entry. Debentures account debit to bank account. That is in your book. Debentures you are going to cancel. It is as same as redemption of preference shares. Have you remember? Redemption of preference share. Same thing here also we are going to do with. Got it? Redemption of preference share, what we did, same thing here also, but here imagine it is a debentures. It is a debentures. Got it? So there, to the extent of face value of the preference shares redeemed, we supposed to create capital redemption reserve. Correct? But here, since debentures are redeemed, it is not part of capital. So therefore, CRR is not required to create. But before redemption, some DRR supposed to be created. DRR. So that's what amended rules and all. So because of that, the confusion was started between the students of last November attempt and May attempt. Because from December, the amendment was issued. So therefore, the material was revised. The material was revised. So before that, it is a normal. It is a normal. Now, my dear friends, in case of debentures, that's a redemption of debentures. Redemption of debentures means, my dear friends, officially it is a cancellation. That is, in your book, the debenture certificate has to be cancelled, tear off. Then only we can call it is officially redeemed. So until the debentures are cancelled, it is not said to be redeemed. That is the first thumb rule. That is the first thumb rule. Now, so redemption of debentures. So what are the alternatives or alternatives methods for redemption? Alternatives for redemption. Alternatives for redemption of debentures. Got it? So we have 4 alternatives for redemption of debentures, my dear friends. 4 alternatives. Number 1, I can redeem. Redemption means, imagine it is a cancellation. Correct? So I can redeem at first is lump sum payment. Lump sum payment. This is what first alternative. Second alternative or method for redemption, what I am saying, lump sum payment. Second method is drawing a lot. Drawing a lot. That means installment. Installment or batch by batch. Installment or batch by batch. Batch by batch. Next, batch by batch. Next, third one, it is a purchase from open market. Purchase from open market. Purchase from open market. Last option is conversion into shares. Conversion into shares. Conversion into shares. Now, if it is lump sum payment means, my dear friends, it is one time purchase or one shot payment. One shot payment. Or in one installment, that's all, my dear friends. In one installment, that is, I will wait for 5 years. At the end of 5th year, in one shot, I will pay the amount and I will purchase everything. I will purchase everything. So that is what first point, what we call, it is a lump sum payment. Second one, it is a drawing a lot. Drawing a lot means batch by batch. Like how I said, suppose if a 5 lakh is a debenture value of investment, holding period is suppose 5 years, or it will say that every year it will be redeemed in the 5 equal installment. That is 5 lakh divided by 5. Every installment is 1 lakh. So that means every year 1 lakh will be redeemed. Either it is redeemed directly by the company through directly from shareholders, or there might be debenture trustees. Hope you would have heard that debenture trustees. That is, look out, board of directors are there to act on behalf of company. Got it? But auditor, suppose if it is there, he has to report to the shareholders of the company. Internal auditor has to report to the what we call internal, completely for the management. Internal auditor is for management. Statutory auditor is for shareholders. Like that for the purpose of debentures, my dear friends. So hope debentures are nothing but floating loan security. That means all the assets of the company is secured. So that means in order to control, or in order to take care of the grievance of the stakeholders of debenture capital, there might be one group or one trustees which is formed, which is called as debenture trustees. That debenture trustees will monitor the activities of debenture holders, and they will represent on behalf of debenture holders with the management of the company. So there, company would have been said, look out, I'm going to purchase every year 1 lakh. So that is, with whom we supposed to purchase, you take the risk, you take the responsibility. By at the end of the year, what you're supposed to do, order to debenture holders, by the end of the year, 1 lakh you have to purchase and hand it over to me. In my book, I will cancel. Yeah, responsibility is given to debenture trustees. That's also possible. Or directly, company can purchase from the shareholder. There is a debenture holders. That's also allowed. So it is installment. Another third component is purchase from open market. So purchase from open market means, my dear friends, it is who are all disinterested shareholders, disinterested debenture holders are there. They might have traded their debenture certificate in a market, share market or securities market, what you call open market. So from there, company will purchase. Company will purchase the debentures. If they purchase the debentures, either immediately they have purchased, but either they can immediately cancel or they can hold for a while, and at the end of the year they can cancel. Like these options are there. But since the chapter is modified, so there are no much variety of model of problems. Just they have given just a lighter problems in your study material, my dear friends. But if you understand the conceptually, many things are there. Got it? So here lump sum payment, that is okay. So drawing a lot. So for this lump sum payment, drawing a lot, etc., in earlier, before the chapter was revised, my dear friends, conceptually, even now conceptually, so there might be the debentures you are purchasing out of profit, or by sale of by selling the asset you are purchasing, or by fresh issue. You are going for issue of shares and purchasing the debentures, or you are going for sinking fund, etc. Like these options are there. If it is out of profit, with the sinking fund, without sinking fund, like these models were there. Now, because chapter was revised, there is no adequate problems for that. So just they have given whatever in a model. So just normally there is no funds. So whether company funds is there, either they will go by either lump sum payment or drawing a lot or purchase from open market, or if it is a conversion of shares, means here no cash outflow will be there. Here conversion of shares, only here there is no cash outflow. But for all other things, the cash outflow will be there. So that in a problems, all your problems, they have ensured that so company has a sufficient cash balance and therefore they are going to redeem. That's how they have been. Got it? But in a reality case, they might have either out of profits or out of fresh issue or out of by sale of assets. Out of profits means with sinking fund, without sinking fund, like this was there. But now with the sinking fund concept was removed, because DRR will act as a sinking fund only. DRR will act as a sinking fund only. Suppose if you want, no, at the end of the time, I might be end up by, there might be cash crunch. So therefore better, I will create one fund and I will invest equal to that in an investment. So corresponding that sinking fund as well as sinking fund investment, you can create nothing wrong. So since practically, so companies are not followed, that concept was removed, that's it. Got it? But if you want to follow, it is very much allowed. So that's how. Now, my dear friends, here, purchase from open market means from a securities market, you will purchase and you will cancel the debentures. Got it? If it is a debentures immediately cancelled, fine. Otherwise, till it is cancelled, the debentures is holding in your hand as an investment in own debentures. Like how your money, suppose if you purchase some other company debentures or shares or whatever it might be, so it can be treated as an investment. No, like that here you have purchased your debentures only as an investment. Till it is cancelled, it is not a redemption. It will be treated as an investment in own debentures. So if it is investment in own debentures, interest has to be calculated on debentures in full. But at the time of payment, your portion, that is to the extent of face value, what company has hold in the hands as a own debentures, to that extent you have to credit to P&L as a income from investment, and the total debenture interest will be transferred to P&L as an expense. So voice is breaking. Wait, my reference. Yeah. Now check out. I hope voice is clear now. I hope now voice is clear. Yes. Thank you. So because to allow the student to speak, I have diffused my microphone. So it was like webcam microphone was using. So therefore little disturbance might be there. So now I seen that. So thank you guys. Thank you. Okay. Now let us continue. So last one, if it is a conversion, if it is a conversion into shares. So here debentures are cancelled and it is converted into shares. So if it is converted into shares, automatically debentures are cancelled. So therefore that is also cancellation of shares, but it is not by mode of cash. So all these three, my dear friends, out of this except last, all these three modes, correct? It is through source of funds. Through source of funds, that means by cash. So this is either it can be out of profits or fresh issue or by sale of asset. Sale of asset is also profit only. So this we have proved you in redemption of preference shares. If you sell the investments or whatever it might be, out of that if you redeem, it is as same as it is redeemed out of profit only. Got it? So same interest normally it will flow, but here the variety of problems we will not discuss when if it is a old syllabus. Suppose if those who are there, because this video will be shared to May students also, those who are appearing for May examination or July examination, for them also it is amended. So for them in a class, what we discussed in a old scenario, we would have shown the source of funds are of three types, which is out of profits, with sinking fund, without sinking fund, then fresh issue, then sale of assets, like this will be there. But here in your amended chapter, like this source of funds and all, they have not discussed. It is assumed that since the model of problems has not coined well, so only limited problems are there. So just they have gone with just a model. If it is, if you are purchasing lump sum payment, how the entry? If it is purchasing out of drawing a lot, how the entry? Yeah, if it is out of purchase from open market, how the entry? If it is conversion of share, how the entry? That's all. So they have not discussed about how the source of funds you have maintained. So that completely the liberality has been given to the entities as a whole. So whether if you have a funds directly, so out of profits directly without sinking fund, go with. If you have a sinking fund, anyway DRR you're supposed to create, for that mandatory provisions has been inserted. So if DRR is created, DRR will act as a sinking fund. Therefore, using that funds you can create it. So here we have given minimum criteria for DRR. That's it, not maximum. Minimum, this amount should be there. Yeah. So if you are the company, if you want to create more than that, very much allowed. That's how the problem or chapter has been designed. Got it? So keep in mind. Now let us go for the things. So source of funds here, I will not discuss about what the source of funds and all. So your assumption, I am going to purchase either from lump sum payment or drawing a lot from the market, or from purchase from open market. Lastly, conversion into shares, that entries. That's all. So for that source of funds, I assume that there will be adequate funds. If not there, in a problem, they will say, I will go for sale of asset or I will go for fresh issue, etc. They will go. They will say, so based on that, entry will be passed. That's all. Got it? Now, this is just a glimpse of case. Now, all the entities, my dear friends. So here, there is a mandatory provision has been in the rules, in amended rules of 2019. So share capital and debentures amendment rules, they have modified that and they have inserted a rule that all the entity, so that is they have defined. So entities which are banking and others, listed, unlisted, etc. That category they have inserted, so that there is a mandatory provision. So if you are covered with that category, DRR at the time of issue itself, DRR has to be created. Correct? So therefore, since you are creating the DRR for the purpose of redemption separately, one reserve you are creating. So for the namesake, for the premium, instead of they are calling it as a DRR, debenture redemption reserve, they have modified the name as debenture redemption premium. They have redemption premium, but it is in the nature of expected provision or liability itself. So that's why in a foundation this and all, so instead of DRR they're supposed to use debenture redemption premium. Reason is this reason, because of at the time of issue itself DRR supposed to be created because of modified version. So this now the new things we're supposed to design. Got it? Now, let us go, my dear friends. If it is, what's the mandatory provision? Who has to create DRR at the time of issue itself? I'm not talking about redemption. Yeah, at the time of issue itself, it has to be redeemed. It has to be created DRR. Suppose if DRR is not created, then at least, suppose if, for example, 5 years is the duration of debentures. Now, 4 years, that's the first year when you are issuing, that day itself you're supposed to create DRR. Suppose if DRR is not created at that time of issue, then because of amendment, these rules are there. Suppose if next year you are going to redeem, that is at the end of this financial year you are going to redeem, correct? Then at least this year at the beginning itself create the DRR. If you have created at the issue itself, fine. If not, at least the year in which you are going to redeem, so in that year create DRR before it is redemption. That's the meaning. That's how the chapter has been designed. That's how the rules has been designed. Yeah. Now let us go. Who has to create DRR? Who has to create DRR? So that's what first things. This is what we are going to create, discuss as adequacy. Adequacy of DRR. Adequacy of DRR. That is, which entity has to create DRR? Which entity has to create DRR? Now, for the purpose of this, my dear friends, entities are classified into two types. For the purpose of this, entities are classified into two types. Entities are classified into two types. First variety is, my dear friends, all India. So finance institutions. All India finance institutions, it is called as AIFIs, which are regulated by RBI and banks. And RBI and banks, which are regulated by, usually it is a RBI as well as banking regulation. Next one, other entities. That is, here financial institutions as well as banks. So these both are dealing with finance only. So financial institutions. Here other entities are classified into two types. These are classified into two types. So this is NBFCs and HFCs, housing finance companies. Then other companies. Yeah, sir, why you are using other companies? Here also other entities means here also companies only, my dear friends, because debentures can be issued only by companies. Debentures can be issued only by corporate. So therefore here entities can be replaced as company. Now, so here out of NBFC, further we have two criteria. Number one is listed, unlisted, as well as other companies. What we have, other companies also we have a two category. Which is listed and unlisted. Now, if it is all India finance institutions, which is regulated by RBI as well as banks, if it is such companies, there is no requirement to create DRR. Therefore, no DRR. Nothing to require to create DRR at the time of issue or during the holding period, that is before redemption. There is no requirement to create DRR. No DRR. Next, let's go to the other entities. Out of other entities, if it is NBFC and HFCs, whether it's a listed or unlisted, for this also no DRR, no DRR, no DRR. If it is, look out here, what and all in a mind, just fix it. Financial institutions, banks, no DRR. NBFC, whether it's listed or unlisted, no DRR. Next, except banks, except financial institutions or banks which are governed in category 1, or NBFC or HFC, whether it's listed or unlisted, except that entities, other companies. That's what we classified. Except those, everything is a other company. In that also, in other companies also, my dear friends, if it is listed, again no DRR. If it is listed, no DRR, but if it is unlisted, only for this you supposed to create, DRR has to be created 10% of value of outstanding debentures. Value of outstanding. Value means here, value means, my dear friends, face value of outstanding debentures. Face value of outstanding debentures. Outstanding debentures issued. So only, that is only for other entities. That means it should not be, imagine, it should not be financial institutions, banks, or NBFC or HFCs, whether it's listed or unlisted. Even other entities also, if it is listed, DRR is not required to create. Yeah, only for unlisted other entities, you supposed to create 10% DRR on the value of debentures outstanding on the beginning. So this 10%, my dear friends, usually this what we have to create. So in the year, at least this 10% you're supposed to create in the year, at least before to redemption. So that's what, if you come to our, so if you come to the explanation, you can have the words. So here in this case, you can see this. In this explanation, you can see it. You can have the access in page number 67, I think, in your book. So in a handout. So look out. So DRR, debenture redemption reserve, has been, it is debenture redemption reserve and investment or deposit the sum. So this about a deposit, there is a second case, that's a DRI, debenture redemption investment. What to do, that in a second explanation I will explain you. Now, in respect of debentures maturing during the year ending, that means if this is the financial year, suppose if this is the financial year, whatever be, suppose if the 5 years is the duration, so this is 4 years, this is 5th year, correct? So the 5th year, if this is the year maturing 31st March, suppose it's the 20, if this is the maturing, at least this day beginning, this year beginning, you supposed to create this provision, you have to comply this provision. Not on here, at least beginning of this day, this year, you have to create DRR. That's what here we are saying. Now this is the financial year, so this is the year which is maturing at the last, correct? So for this, maturing during the year ending on the 31st day of March of next year. So that is, this is the financial year. So friends, I have shared the notes, so please don't say again. Yesterday itself I have hosted in a group. Yeah. Now, so now March of next year. So that means this is 31st March is over. Now this financial year, this is ends. So this is next financial year for this previous year or this financial year. If it is not created, at least first day of this you supposed to create. In accordance with this condition, the debenture redemption shall have created out of the profits of the company available for the payment of dividend, the limits with respect to the adequacy of DRR. So this adequacy only that they have discussed in this chart. Yeah. So now usually this will be at the beginning of the year. It's supposed to be DRR. Before redemption, it's supposed to be created. Friends, understand? So if it is year is 5 years, at the time of issue itself, DRR, it's supposed to be created with this adequacy. Either 10% means the 10% of the amount of debentures outstanding is supposed to be created and hold. Suppose if you have not created, at least by, suppose if next year, that is if the first year you are starting, this financial year end, you are going to redeem, means at least this year you're supposed to create. At least this year you're supposed to create. So this is what this table what I have compressed. This is a table what I have compressed in this chart. This is what I compressed in this chart. Think of only it is other companies which are not NBFC, HFCs or AFIs or banks governed by RBI. If it is unlisted, then only 10% of the value of debentures equal to that DRR supposed to be create. DRR supposed to be create. Got it? So this is part 1 of the amendment. So adequacy of DRR, that is only unlisted other entity supposed to create a DRR equal to 10%. At least this is not maximum and all. This is at least minimum. It has to be 10%. DRR shall be 10% of the value at least. Suppose if you are creating first, now itself I am creating a complete amount every year 10% I will keep on accumulate based on sinking fund. You can create. That is nothing wrong. Here at least for the compliance 10% you're supposed to, minimum mandatory you're supposed to create. That's the case. Yes. Next, let us go to the second amendment. Second amendment, which is DRI, whatever you have created here. Sorry, DRR, what you have created this reserve, for that corresponding investment I supposed to create. Corresponding investment I supposed to create. That investment, what we call it as here, investment of debenture redemption reserve. Investment of debenture redemption reserve. Got it? Redemption of debenture redemption reserve. So that means how much, if a DRR you are creating, that is correct. That is, here look out, it is not all the entities supposed to create a DRR. It is not all the entities supposed to create DRR. Only unlisted entities you supposed to create DRR. Correct? But my dear friends, here for the purpose of investment, it is all entities. All entities has to create DRI, debenture redemption investment. You have to create out of DRR, whatever is there, investment out of DRR you supposed to create. Investment of DRR you supposed to create all the entities. All the entities, there is no second thought. So how much they supposed to create? All the entities, at least 15% of face value of debentures outstanding. Face value of debentures outstanding or which you are going to withdraw. So equal to that 15% you are supposed to invest in DRI. Investment in DRI is supposed to invest. So this amount, if you are issuing today, debenture issuing, if you are creating today, at least this 15% you have to invest by the end of 30th day of April. That means 30th April every year. Suppose if you are issuing here, minimum at least it is entertainable by, if you are investing before 30th April of this year, it will be very good. So that means this year, suppose if you are issuing the debentures, means you collected the amount, correct? Now itself DRR, suppose if you are covered with what we call 10%, that's unlisted criteria. So DRR you supposed to create 10%. DRR in 1st April or end of that year, you have to create the 10%, as well as by the end of 30th April. So 1/4, suppose if you have issued, 1/4 if you have issued, by the end of that month itself, at least 15% of this face value, whatever is there on this face value DRR, if it is unlisted. Unlisted, this is whether it's listed or not, for all company, this debenture redemption investment, DRR investment is holds. For all the entities, it is applicable. Not only for unlisted this and all, whomsoever created DRR and all, for all the entity, it is applicable. So now 15% of face value you have to invest by the end of 30th April. Corresponding investment you're supposed to create. So don't ask, sir, why there 10% here 15% and all. So please don't ask such question. It is rules. This is what company law said. It is not my words. Yeah. Except this chapter, other things are, if you would have said, I would have given the logics. This so etc. etc. This I would have given. But here, there is no logics. It is completely purely based on law. So this law said, so it is, if you are covered with unlisted entity, you have to create minimum 10% DRR. Okay, I will create. That's all over. That's not my job. For face value, for that how much is 10%, and for that how entry has to be passed. That's all my job. Got it? Second, if it is entities. So correspondingly, you have to make an investment by the end of 30th April, preferably. Suppose if you are not issuing the debenture at the beginning of the period, then it is any day you can do it. Correct? So that's what at the end of that year, at least create it. Preferably 30th day of every year. By that you have to create. That's what the law says. So here correspondingly 15% you're supposed to create. Now for this, how the theory has been designed, come and read. Now look out. Further, as per rule 18, the company's share capital or debentures amendment rules 2019, the following companies, look out, all listed NBFC, listed HFCs and other listed companies other than AIFIs, banking companies and others. So that means, and all unlisted companies which are NBFC. That means in our chart, suppose if I show you, wait a minute. In our chart, if I show you, look out. In our chart, except this category, for this, about this, they are saying, they are saying, got it? So except all entities here. So see the notes. Except all India AIFIs and banks, you have to create DRI. That is an investment you're supposed to create for that. All other listed entities other than banking, AIFIs, banking companies and other financial institutions, and all unlisted companies which are not NBFCs, shall on or before 30th day of April in each year in respect of debentures issued, I repeat, deposit or invest, as the case may be, a sum which should not be less than, that is the word, not be less than. That means if you want to invest more than that, allowed, but it should not be less than 15% of the amount of debentures maturing during this year ending. Yeah. So how much it is going to mature? Suppose if you are withdrawing in a part by part, that is in an installment basis. Suppose if you are withdrawing, so how much ever you are going to withdraw, etc. If it is there, equal to that, at least 15% you're supposed to make an investment. Now next year, year ending on the 31st day of the March of next year, in any one of the more of the following. So that is this mode of investments they have given. So either it can be in a schedule deposits in a scheduled bank, or unencumbered securities of central government, or unencumbered securities mentioned in the class D to E of the section of the Indian Trust Act, or unencumbered bonds issued any other companies which is notified under class of Indian Trust Act. Now the amount deposited, what amount you have deposited, suppose it's a fixed deposit, it should be like lock-in. That means you should not use for any other purpose, because it is earmarked for the purpose of redemption. Correct? So therefore you should not be used for any other purpose. So amount deposited or invested, as the case may be, above should not be utilized for any purpose other than the redemption of debentures maturing during the year. This is what the source, what they have said. Since you have created that amount at the time of redemption, so at least 15% investment you're supposed to make. You sell the investment or you realize the investment, out of that whatever comes, you use it. So correspondingly, what DRR you have created, that is notionally for security purpose you have created, my dear friends. After redemption, that will be transferred back to, again, general reserve only. That entry, when we go, you will understand. Provided that amount remaining deposited or invested, as the case may be, shall not be any time fall below. That means here at the time of that is April, you have deposited. Yeah. Now you said at least anyway at the end of the day only, I have complied the law, but at the end of the day only I required 15%. No. So therefore, what you did, deposited. After 1 month you withdrawn. So thereafter, at the end of the year, again you deposited that amount. So that at least money is available. Opening and closing, it is there. Correct? It is not so. It is like as same as like share capital. So if any one day, if it is share capital falls below the minimum requirement of capital, company stands dissolved. Like that here also, it should not fall below first day. If you have deposited minimum 15%, if it is there, at least if you have deposited more than that, suppose 25-30%, if you have deposited, at least if you would have maintained withdraw, deposit, whatever might be, if you do, and if you maintain all the time 15% all the day, fine. Suppose if any day, if it falls below 15%, then it is violation of the criteria, violation of the conditions. In case partly convertible into debentures, if it is there, DRR shall be created in respect of non-convertible portion of debentures issue in accordance with this sub rule. Yeah. So now, suppose if in a previous case, my dear friends, suppose if here DRR is there, correct? So DRR is supposed to create at 10% of debenture value. But here debentures, I have issued fourth option, conversion into shares. Suppose if conversion into shares are there, that is not complete conversion, only partly conversion. So this is convertible into shares and this is a non-convertible portion. Non-convertible portion, correct? Only for non-convertible portion, whatever the face value is there, for that only the 10% whatever DRR is there, that DRR I supposed to create. Only for the non-convertible portion, not for convertible portion, because for convertible portion anyway cash is not involved, therefore there will not be any contingencies or what we call any risk involved. So next, my dear friends, the amount credited to DRR shall not be utilized by the company except for the purpose of redemption. So whatever the DRR amount is there, that we can use only for the purpose of redemption of debentures. So next, it should be noted that the appropriation DRR can be made any time. Appropriation, that means transfer from that P&L, from P&L to DRR. What you do, correct? This can be appropriation or DRR can be made any time before redemption, and investment in specified securities as mentioned above can be done before 30th April for the debentures maturing that year. However, the sake of simplicity and ease, it is advisable to make the appropriation and investment immediately after the debentures are allotted. This is what I have explained so much, my dear friends. This is what key. This is what the key in this content, assuming that company has a sufficient amount of profit. That's how the problems has been designed, because since it is a initial stage of the chapter, so this how assuming that company has adequate profit, so therefore out of that you create. That's how the problem has been designed, correct? But concept is still more detailed. Concept is there, but since only the few problems has been given, I will also stick to that. Whenever that topics has been increased, that time I will also increase my explanation. So now I will stub up only to the extent what the topic has been covered. So here look out. So one hint what they have given, DRR supposed to be created. That is a damn sure. If it is covered with adequacy ratio criteria. Then debenture redemption investment also is supposed to create. That's investment out of DRI. So usually anytime you can create, but preferably during the year, suppose whatever is created by the end of next April, if year end is over, by the end of April, 30th April, you invest it. That is this year end, suppose if you are creating, at least within 1 month you invest it. That's the meaning. Yeah, but it is advisable to create a DRR. DRR also anytime you can appropriate from profit to DRR, anytime you can create. Investment also anytime you can make, but it is advisable at the time of allotment, the moment allotted, immediately if you would have rendered your responsibility is over, then headache is over. It is a compliance has been made. So 10% DRR as well as 15% investment, if you would have invested, really it would have been happy. Yeah. So also in some cases, so that is issue of allotment date is look out, then also has a sufficient amount of profit issued if allotment date is not given in this question. Also in some cases the date of allotment could be missing. In such cases the appropriation and investment should be done on the first day of that year, that is 1/4 of that year in which ledger accounts are to be drafted. That's how, because it is a since it is the initial stage of the problems or chapter, my dear friends, just 2019 it has been amended. So therefore it is a 2020. So from December it has made applicable. So therefore much time is not there to draft or coin adequate problems. So therefore simply they have said if the information is absent, we assume that at least first day itself. Therefore based on first day itself we will pass accounting entries. That's how the things are there. So that is relating to the theoretical amendment. So then when we go for journal entry, so we will go for, so if it is lump sum payment, how it will be. If it is redeemed out of installment, how it will be. If it is out of purchase from open market, how it will be, and conversion into shares. So first journal entry concept I will cover. So thereafter I will go for entry, because in one shot I will cover all the journal entries. Then using that I will go for problems what we have given. So first issue of debentures, this problem and all, just for your sake, when you have a time, just go through. I will directly go for redemption of debentures from problem number 7 only. From problem number 7 only, all questions. So in the absence of information or source, we have copied. Everything is from our ICI material only. Yeah. So now take a break. What's the time now? So time is 7:53. So take a break till 8:05. 8:05. Let us assemble at 8:05 to discuss journal entries for the redemption of debentures.